Make sense? Cool. Let's progress on to the next case study, which we are going to look at a doctor who is starting a policy at the age of 40. He is practicing medicine and he's got some student loans. So his loans are $350,000. Currently, he's paying interest only. So here's his plan. He wants to fund a policy with $100,000 per year for 10 years. What that allows him to do, firstly, is move $1 million into a safe asset class. He's interested in the cash value because it grows safely. He can access it tax-free. That's very attractive to him. And he says, hey, long term, this is a nice asset as part of my overall retirement strategy. I like this idea. So he's got that. And then also, it gives him life insurance, which is a concern of his. So what we're going to look at here is how he can use the policy to pay off those student loans in addition to having that policy for retirement with the other items that he mentioned. Here's what we're going to look at with this one. So the first thing we'll look at is growth. What does that policy look like if he puts that $100,000 per year for 10 years away and just lets it sit and grow? Why we want to start here is because when we start to see the impact of policy loans, we can compare it and see side by side, hey, did this benefit me or did it hurt me? And what we're going to compare it with is a $350,000 loan. But first, what does that look like if I never pay the loan back? Meaning I don't pay any loan principal, I don't pay any loan interest, nothing. I just take the $350,000, clear the student loans, and I heard, hey, I don't have to pay back life insurance loans, so I'm not going to do it. We'll see what that looks like first. Then we'll look at paying interest only forever, and then paying interest only until he's 50, and then starting to repay the loan. And then we've got a bonus one. We're going to look at taking income down the road. So let's take a look here. Like the last one, we've got the illustrations up. So here's what this is based on. A different product. Since we only want to fund for 10 years, we're going to look at a 10-pay product. And I'll say this, when we look at some of the major mutual companies, like a Mass Mutual or a Guardian, they're 10-pay products. Mass Mutual also has an 8-pay product, do produce strong internal rates of return. The companies design those products for cash accumulation. So in many cases, we can see very attractive numbers, not to say we wouldn't use other products, but the numbers will look good here. So here's your cash values. Just when you reference this with the Excel workbook, knowing that the Excel numbers just reflect what we have here, everything will match up. Here's your growth. Here's your $100,000 per year for 10 years. Here's your total payments. What's highlighted in yellow represents your break-even point. That's between years 4 and 5. There's your death benefit. Here's your annual ROR. You know what that means? Rate of return. You'll also see this in the Mass Mutual illustration as well. This just shows the net rate of return on a yearly basis. And then you've got the internal rate of return, which is a fancy way of looking at the averages over time. So, tops out right around 5.5%, a little bit stronger. Looks good. Keep those numbers in mind, and let's compare that with loans and no payments. So, what do you see here? So here's your growth illustration. Loans. He says, these student loans, I'm tired of them. They call for it every month. I just want them paid. All right, let's pay him. So he's got enough cash value in the policy to pay him off. So he takes a loan of $350,000 and says, student loans, see you later. So they're gone forever. That's great. Now with the policy here, we're going to pretend that he never pays anything on the loan, that is. He keeps on funding $100,000 per year for 10 years because that was his plan. But that loan compounds over time. If you don't pay the loan interest, it will compound as time passes. If you ever heard that loan interest on life insurance policies is simple, it's simple only over the course of a year. life insurance loan interest accrues at what is called annual simple interest, which just means over a period of a full policy year, it accrues at simple interest. If you don't pay it when it's due, it will compound. But in this example, if we look at the 10th year, how much did he pay in? 10K per year, I'm sorry, 100K per year for 10 years is $1 million. But he also pulled out $350,000, which means the net out of pocket here will be $650,000. How much does he have? $728,000. What happens as time passes? Because that loan interest keeps on compounding. Does it hurt him to the point where he starts to lose money? No. And we can scroll all the way down. What will happen in this case is the cash value. This is the net cash value, net of the loan. This will just continue to appreciate along with the death benefit as well. So that demonstrates a scenario where we don't pay any of the loan interest or loan principal. Let's look at an interest-only scenario. So look at the loan of $350,000 in the 4th year. Ready? Next tab. There's your loan, $350K in policy year 4. Okay? What happened to the loan balance in this example? Stays the same. Why? What he's also paying is the loan interest that's due. So in red, you see what the insurance company is billing in loan interest, but in light blue, you see what he's paying. So he is paying just the loan interest. So what you'll notice in this example, as you scroll your eyes down, the cash value and death benefit is always going to be about $350,000 less than the example to the left. Because the example to the left assumes what? Growth only, no loans. Let's look at the next example. So here's paying it back. And this is a pretty cool payback schedule because what we wanted to look at in his case is he's got the funding of $100K per year for 10 years. He takes the loan of $350,000 out. As a result, his equity drops. He's at $39,000 and change. There's your death benefit of 1.65. Compared to the example with the left, same pattern. Cash value dropped by about $350. Same thing with the death benefit when we look at these numbers over here. But now, what he wants to do is for the next 6 years, while he's funding 100K, he feels like paying down the principal in addition to that might be a little bit stressful. While he could do that, he says, you know what? Can I just pay the loan interest? That way it doesn't compound and then start to attack the loan after I've got my $1 million into the policy, because that was his goal. The answer is yes. I can do that no problem. So what he did is pay interest only. Then after the 10th year, when he's 50 years old, he had been paying 100K per year into the premium and PUA rider. Now he's just redirecting that to the loan. And when that loan is paid, there it is. If you don't touch it, here it is. When you touched it, but you put it back. What do you notice? Fully restored to exactly what it would have been as if we never touched it in the first place. Same thing as the younger individual who used her policy to buy a car. This example is just a larger case study. We've got a bigger dollar amount going in and paying off a larger loan. Now, he wanted to use this to pay off his student loans, but what else? Do you remember? Retirement, using it for income down the road. So let's look at how much he can pull in income. So we're starting this illustration year 15 when he's 54, but he's going to start to take income down here at 64 years old. And he's able to pull out $165,000 per year. We're doing this through loans in this example, and we did that up until 90, which he's got juice left in the orange too. So if he wants to pull out more income, he easily can. But he pulled out $165K per year for more than 20 years in this example. It's about 25. and he paid in $100K per year for 10 years. And this was what he viewed as a safe place to put money. And he's also got the tax benefits. See why he did it in addition to the loan strategy? So that was our doctor. Next, what do we got? Paying off a mortgage. So this is a good one here.